And a hawkish Fed Governor Chris Waller ending the day by saying if the data continue to be too hot, the policy target rate will have to be raised above his range of 5.1 to 5.4%. That is higher than 5.4%. The title of his speech was about the February hot data, and he said the Fed cannot risk a revival of inflation. If the data moderates, however, in March, he does support a range in the 5.1 to 5.4% terminal rate, which is where the committee is right now. But he said the data from February showed inflation is not coming down as fast as he had expected or thought. The fight to bring down inflation will now be slower and longer than many expected just a month or two ago. Inflation data indicate that they haven't made as much progress as had been thought, and that's because of the revisions that we got in December for the December and November data. Consumer spending isn't slowing, he says. The labor market is unsustainably hot. Recent data show, he says, instead of loosening the labor market, it was in fact tightening, and that is in reference to the 500,000 jobs created in January. No concern, he says, that there's a risk of raising rates, that the risk of raising rates is two-sided. He said it's only one-sided, and that is the risk that they won't do enough to fight inflation. Recent data show progress on reducing demand may have stalled, and that's in reference to the retail sales numbers. He does say there are reasons to be optimistic about continued improvement in inflation, but no change is his plan, and maybe even going higher, Morgan, if in fact the inflation data does not cooperate.
We've been hearing it a lot in recent days from Fed officials, this focus on data dependence, which perhaps is not anything new. But how would you compare this versus the comments we got from Bostic, which basically led to an afternoon rally where he essentially said, you know, data dependent, he's looking at 25 basis points? Yeah,
I mean, I don't always hear what the market hears, Morgan. I didn't hear Bostic be all that dovish. And I get that the market was cute to that the market turnaround was cute to his comments, but I listened to his call and I asked one of the questions, and I didn't hear him be particularly dovish, maybe not as hawkish as Waller was right here, because certainly Waller is already flagging you that this number, this target range, which is kind of capped at 5.4% in the dot plot, could be higher. And he's also talking here, Morgan, about how dramatically the January and February data has changed his view about what he thought had happened and what was going to happen. So it was two-sided for him.
All right. Steve Leisman, always giving us a little more Fed context. Thank you.